These stocks are royalty. Dividend kings are stocks with at least 50 years of consecutive dividend growth. Procter & Gamble. This household name has raised its dividend for a hopping 66 years in a row. Genuine Parts. This auto parts business also has a 66-year dividend growth streak. Illinois Tool Works. With 58 years of dividend hikes, Illinois Tool Works stock is a great pick among the dividend kings. Let's dive in. Here are the 3 dividend kings to buy for safe dividend growth. Welcome to Timely Investment Research. At a time when inflation remains an issue, geopolitical risks are rising, and the threat of recession looms large, insisting on quality, safety, and dividends when picking stocks is more important than ever. In this video, we will look at 3 dividend kings. These picks offer solid yields and safe payouts, along with very impressive 50-plus year track records of growing their dividends. Indeed, with recession on the horizon, investors are increasingly emphasizing quality, safety, and dividends in their portfolio selections. With these dividend kings, investors will have access to 3 stocks that not only have been able to generate long-term dividend growth, but also proven to be resilient in the face of adverse economic conditions. Number 1. Procter & Gamble. Procter & Gamble is a very popular dividend stock thanks to its remarkable track record of growing its dividend for 66 consecutive years in its popular consumer products brands. Recently, the company pruned its product portfolio in order to focus on its best brands and product lines in order to maximize profitability and long-term organic growth. Some of these leading core brands are Gillette, Tide, Charmin, Crest, Pampers, Febreze, Head & Shoulders, Bounty, and Oral-B. It repurchased stock with the proceeds from selling off brands, unlocking value for shareholders. Moving forward, the company should be able to drive earnings per share growth through a combination of share repurchases, margin expansion due to a combination of cost cuts, improved economies of scale, and price increases, and revenue growth due to continued investments in its powerful brands and most successful products. The company may also elect to grow through strategic acquisitions like its recent $4.2 billion purchase of Merck's global consumer health business. One of the best things about investing in Procter & Gamble right now is that it is a proven performer during recessions. During the Great Recession, it grew earnings per share from $3.04 in 2007 to $3.53 in 2010. This is largely because it commands strong competitive positions in product lines that are considered essentials. As a result, customers are very loyal to Procter & Gamble's brands and prioritize purchasing its products over other, more discretionary spending when hard economic times hit. Number 2. Genuine Parts. Genuine Parts is another great dividend growth stock with an impressive 66-year dividend growth streak. It has the world's largest auto parts network, with over 10,500 locations across 17 countries. It also employs approximately 53,000 people. The company derives roughly 2/3 of its revenue from its automotive parts business. The other third comes from its revenue from its industrial parts business. Its automotive parts business is best known for its Napier brand. Meanwhile, its industrial parts business serves primarily maintenance, repair and operations businesses, as well as original equipment manufacturer customers, spanning a wide range of industries such as mining, energy, and healthcare. Moving forward, we expect the economic environment to boost demand for genuine parts services. This is because when times get tough, customers hold onto their existing cars and equipment for longer. As a result, they will likely be purchasing parts from companies like Genuine Parts. This steady performance in the face of recession is reflected in its relatively stable earnings per share performance during the Great Recession, when it saw its earnings per share go from $2.98 in 2007 to $3 in 2010. Genuine Parts operates in a massive total addressable market of nearly $500 billion worth of business. It intends to continue growing earnings per share at a solid clip, in part by consolidating its enormous addressable market via organic market share capture and strategically acquiring smaller competitors. It can then implement its economies of scale and other competitive advantages to unlock synergies from these smaller acquisitions. Another manner in which Genuine Parts plans to grow earnings per share moving forward is via aggressive share repurchases. Number 3. Illinois Tool Works. Illinois Tool Works has grown its dividend for 58 consecutive years. The company has been in business for over a century. Therefore, it has a long and storied history of growth and building a vaunted business network and brand power. Today, it operates 7 business segments: automotive, food equipment, test and measurement, welding, polymers and fluids, construction products, and specialty products. The company's earnings per share growth strategy consists of strong organic growth thanks to its strong brand power, opportunistic bolt-on acquisitions, and share repurchases. Over the past decade, the company has reduced its shares outstanding each year. Since 2013, the share count has declined by 30%. The company also has numerous competitive advantages that help it continuously drive steady profits and earnings per share growth over time. These include its immense economies of scale, which give it pricing advantages as well as superior resources for investment in research and development and marketing relative to its competitors. Furthermore, it has a massive intellectual property portfolio that includes over 17,000 granted and pending patents. The company is also constantly pruning its brand and product portfolio according to the 80-20 principle. In other words, it is constantly evaluating the performance of and outlook for its brands and products. Then it divests the 20% that rank the worst while doubling down on the best 80%. By doing this, it is constantly improving profit margins and organic growth and ensures that it is maximizing returns on invested capital. While the company is not recession-proof, it has proven to be able to sustain strong profitability during hard economic times. From 2007 to 2010, it saw its earnings per share move from $3.36 to $3.03. Additionally, it continued to grow its dividend each year through that process. As a result, investors who buy it today should be able to feel pretty confident in the sustainability of Illinois Toolworks' dividend and dividend growth through a potential recession in the coming years. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.